Good morning and welcome everyone to our 5 retirement decisions you can't undo webinar. We'll get started here in just a moment. But first, we'll go over a bit of housekeeping before we get started. First thing is with our webinar, this is recorded, so if you would like a copy of this in the future, please let me know. Two, uh, if you have any questions that you'd like to have answered um, in the webinar, we do have a Q&A feature here in the meeting controls. Go ahead and drop your question into the Q&A, and I will be happy to add the. Oh, there we go. I'll be happy to add in, uh, ask any question or answer any questions as we get to the end of the presentation. Okay, let's see. Waiting for a few more participants to come on here, and then we will go ahead and get started. Give me a moment. All right, let's go ahead and get started. So, as I mentioned, all of the any questions you have, please drop them into the Q&A feature on your meeting controls, and we'll be sure to answer them at the end. So, most importantly, let's talk about why this matters. One of the things that we think about when it comes to retirement planning is there are certain choices that unfortunately are fixed. Once you make them, it is very, very difficult to break them or to undo them. And it's the reversible ones we can adjust on the fly, but the irreversible ones, that's where the planning it becomes critical. Looking on the left-hand side of your screen, when you look at what is reversible, you can change your asset allocation. You can change your advisor. You can adjust your monthly spending. You can downsize to a different state. You can rebalance your portfolio. Any of these things you can do at any time. But on the right-hand side, there are certain decisions and approaches that unfortunately, once you make those decisions, they are permanent. When you claim Social Security, you know, after 12 months, you are locked in for life, and it determines your surviving spouse's benefit as well. The next one is Roth conversions. Every year that you skip Roth conversions during the low income years increases your future years' required distributions and likely tax bill. You can't unfortunately go back in time and do a Roth conversion for previous years. The third one here is beneficiary forms. Unfortunately, most people do not understand that the listed beneficiary on the account does supersede your living will or your trust. So if you have the wrong beneficiary listed, that is a critical mistake. It happens, unfortunately, after you've passed away, but it can leave your family in a bit of a lurch. The next one we'll talk about is the first year withdrawal decisions, what we call sequence of return risk. And then finally, the fifth one, which is portfolio fees. So let's get into it. When we talk about where we're going today, we're going to focus on when you should claim Social Security. There is the potential for a lifetime impact of over $300,000 of benefits that could be lost by making the wrong decision. We'll next go into the Roth conversion window. What makes sense to when it comes to Roth conversions? We'll talk about beneficiary designations. We'll talk more in depth about your first year withdrawal strategy. And then lastly, we'll wrap up with the advisor model and fees. So when should you claim Social Security? That's typically decision number one, right? When you think about Social Security, one of the things that a lot of clients do is they'll go to an online calculator and calculate what's called the break-even math or the break-even calculator. When are you going to, how long do you have to live to get the most money out of Social Security? And when you look at claiming based on the different ages, it can be a pretty dramatic difference. For this example, this is a client who has a $3,000 a month Social Security benefit and a full retirement age of age 67. Pretty typical for our audience. And when you look at the slides, it does show a pretty dramatic spread between the benefits. If you claim early at age 62, it is a 30% permanent reduction on your full benefit. And that's not a temporary haircut. That is permanent for the rest of your life. And the part that most people don't think about that reduction is it also applies to your cost of living adjustments going forward. When Social Security does a COLA adjustment, it is calculated on that lower base. So not only are you taking a lower payment early, but you're also locking in that base for future cost of living adjustments. That gap widens every single year. If you claim at age 67 your full benefit amount, that's 100% of what you've earned. There's no reduction, no bonus for taking it. For a lot of people, this feels like the safe choice, and for some situations it is. But for clients who have two, three, $5 million or more in assets, claiming at full retirement age could mean leaving some extra money on the table, depending on some other variables that we're going to get to here in a moment. For those of you claiming at age 70, the benefit goes up by 24%. You'll notice it's a 3 or an 8% increase for every year that you wait. Okay. Now, another 8% annual, this is essentially an 8% guaranteed rate of return with no market risk. That doesn't exist in our world, right? An 8% guaranteed rate of return. It also, as we mentioned, impacts your cost of living adjustments that compound over time. Now, the real difference between claiming at age 62 and age 70 is up to about $1,600 a month. And over a 20-year retirement, that's $388,000 of benefit. And that's before you account for the cost of living compounded adjustments. Those make that number grow every year. Now, one thing that doesn't get addressed in these break-even calculators is what happens for married couples. With married couples, when one spouse dies, the surviving spouse gets to keep the higher of the two benefits and drops the lower of the two benefits. If you are the primary Social Security benefit and you take it early, then the surviving spouse is locked in on that lower benefit. That's a big difference in the lifetime amount of Social Security benefits. So it's really important that that break-even calculator that we see online, every firm has one, is really just looking at an individual's, how long do you have to live to get your money back from Social Security? But it's the first scrape of a complicated plan. So when you think about your particular Social Security benefit and your personal break-even calculation, there really are four additional factors that the traditional generic online calculators don't look at. The first one is your tax bracket during the delay. If you choose to delay Social Security benefits, you have to factor in what is your current and your future tax brackets going to be. Depending on where you're going to generate those portfolio withdrawals, how you're going to fund your retirement if you're not taking Social Security, can impact whether delaying makes sense or not. If you have liquid assets, cash, bonds, savings that are return of principal, no taxation when it comes to you, then that is a very low, very efficient way to fund your retirement. And it allows the Social Security benefit to compound without taking on additional risk because you're returning your own principal. If you're taking money from an IRA, that's different. That's taxable income. And so now the question becomes, well, what's a better after-tax rate of return? Social Security benefits, which get taxed at 85%, or full IRA distributions, or some sort of combination in between. The second one is your Roth conversion window. If you, again, this is one of the ones that's most overlooked. Between when you retire and when you are required to take out what are called your required mandatory distributions from your IRAs, there is typically an income gap window between those two periods. And the Social Security filing typically falls in between, in the middle of that window. But that filing date can be delayed, right? We can extend it to age 70 instead of taking it at age 67 or earlier. But with that Social Security, that is taxable income, right? Our tax system is a compounding tax system. So any additional income throws you into higher tax brackets, which means that there's less room for you to do Roth conversions if you choose to. Okay. For someone with a $2-3 million IRA, losing 2 or 3 years of low tax bracket conversions can mean $100,000, $200,000 of additional lifetime taxes that could have been, I don't want to say avoided, but better optimized. Okay. We'll get into more of that here in just a moment. The third one is the generic calculators do not factor in the Medicare IRMA thresholds. IRMA is your Medicare surcharge. The more you make, the more income you make, the more you pay for your Medicare services, the premiums. So when you think about taking Social Security early, that can easily trigger the next IRMA threshold. And unfortunately, IRMA is not a phased based calculation. It is a cliff-based calculation. $1 over into the next IRMA threshold can add up to $2,000 of Medicare premiums per person. If you're both on Medicare, then it impacts you both. $2,000 to $5,000 a year of extra Medicare premiums is a hidden tax. And unfortunately, the generic online calculators that we look for, the simple break-even math, don't factor in these income hidden cliffs. Okay. And then we talked about the survivor benefit implications, but this one's really important, especially if you have a spouse that has a moderate to large age discrepancy, if they're quite a bit younger, or if you have a spouse who has health issues. Okay. But again, this is an irrevocable or irreversible decision of setting the base for the survivor's benefit. If you take your own Social Security benefit early and you are the higher of the two Social Security benefits, then there's less benefit for your surviving spouse who's likely to live longer than you if you've got that age discrepancy. This could be, instead of a 20-year retirement, a 30-year decision. Very, very important that we factor in the survivor benefit as well as just your own break even to ensure that the longevity of the surviving spouse is accounted for. Okay. Decision number 2, we're going to talk about the Roth conversion window. It's directly connected to everything we just covered about Social Security. The Roth conversion window, again, is that window or that time period between when you retire and when you claim not only Social Security and required distributions kick in, typically around age 72, 73. This is typically when your income is the lowest. And this is where you have the chance to move money from your taxable forever to tax-free forever tax treatment. Okay. It's very rare that clients, once they kick into required distributions, will ever see these low tax brackets ever again. And it's really important to fill them up and limit the lifetime amount of taxes that you're going to pay. And being proactive here is really important. And as we said, you can't go back in time and convert for previous years. This goes to a key concept that I believe in when it comes to retirement planning, and that's this. It is critical to limit the lifetime amount of taxes that you pay. The less you pay the IRS, the more you get to keep for yourself and for your family. So let's get into this a little bit more. So here is a case study. This was taken from a real client who is, a married couple, age 62, sitting on a $2.4 million traditional IRA. Now remember, $2.4 million in a traditional IRA, that's money that's never been taxed. And in theory, the IRS owns a portion of that IRA. Don't forget that. What this concept does is showing you the two different strategies. Same people, same portfolio, same spending needs. The only difference here is the tax strategy. And again, the key concept here is limiting the lifetime amount of taxes that you pay. Less for the IRS, more for you and your family. Let's keep that in mind. So when we think about taxes, most people think about what do I owe in April? But to me, this is the wrong framing. Really, it's how much taxes am I going to have to pay over the next 20, 30 years? And how much has to go to the IRS and how much can we minimize? So when we talk about an effective lifetime tax strategy, we want to run this sort of analysis, this baseline analysis versus the proposed of how much can we save in lifetime taxes versus how much more do you get to keep based on your risk tolerance, based on your investments, based on your plan. The result in this case was $2.7 million more for the client and $2.6 million less for the IRS. Let that sink in. $2.6 million less to the IRS. That's not focusing on your asset allocation. That's not focusing on the hot stock pick or how we were invested. That's not market timing. That's purely just proactive tax strategy and efficiency in action. This is something that is so important when you factor in your IRMA brackets, your Social Security filing, your Roth conversions, your tax management. All of this is a comprehensive, cohesive plan that unfortunately these generic online calculators don't account for. Okay? Another way to visualize this is to look at the Roth conversion window itself. This is here a model of that same client's tax brackets. What are they going to pay in income tax over their lifetime? And you can see with the red circle here, the window that I'm talking about, the opportunity to prepay some taxes at lower rates before age 73, 74 in this case, where the required distributions kick in, and now you are at a higher tax bracket for the rest of your life. Okay? This is where optimization comes in. Once required distributions begin around age 73, the window closes. And each year between retirement and age 73, those missed conversions means higher future tax brackets and a larger taxable estate for the IRS. So we really want to focus in on that circled zone on the left of the chart. How can we optimize this window? All right. So the next decision that I've seen, and I've been doing this 25 years, is your beneficiary designations. This is a little bit different than the previous two. The first two were about optimization, investment strategy, tax strategy. This one is about proactivity around ensuring that your intent is placed in the right format. What most people don't understand is that beneficiary designations on your accounts override what's in your will or what's in your trust. The beneficiary can walk into where you hold your IRA, give them the death certificate, and claim the account. It doesn't go through probate. The trustee of your trust doesn't get notified. The executor of your will doesn't get notified. It's done directly by the institution that holds your IRA. And unfortunately, I'm going to show you here a scenario where it really did potentially backfire. Okay. So let's talk about this. I'm not really going to sugarcoat it. This can be one of the most devastating and completely preventable financial mistakes a family can make. Here's the story on the slide, and this unfortunately is a true story that I've seen in my career. John was, remarried after his divorce. He updated his will to include his new wife, Sarah, their new children. But what he didn't do was actually update the IRA beneficiary directly. He still listed his ex-wife, Linda. When John passed away years later, Linda went in. She was able to claim the full IRA as hers. Sarah and his subsequent children received nothing from the account. This, again, unfortunately, is a true. I did change the names for privacy, but this is something that I've seen happen over my 25 years. Unfortunately, Sarah did go to her attorney. She did try to challenge it in the court, and the court upheld that the direct beneficiary listing did override the will, even though the will was written later. It is a brutal story. It is unfortunate, but it is something that is preventable. And so one of the things I'm going to ask you at the end of this is, as the one takeaway, is to go and check your beneficiaries, but we'll get to that in a little bit. All right, 3 down, 2 to go. If any of these made you uncomfortable or thinking about, I'm not sure I've fully thought this out, that's the point of this today. We want to make sure that you're not operating on generic assumptions and that your plan for retirement is fully vetted, not only for your risk tolerance, your asset allocation, your investments, but optimized for your life and your goals and your taxes. So a comprehensive, cohesive plan is always going to be tailored around you and not some generic models. Okay. All right. Decision number 4, your first year withdrawal strategy. And I will say this actually speaks to the larger role of your overall withdrawal strategy. When we talk about starting retirement withdrawals, it's really important to understand how you're going to fund your paycheck, fund your retirement over your life. And there's only 3 ways to do it. There's only 3 strategies that work. One is to live solely off of the dividends and interest. If you've got a portfolio that is large enough that you can live off the passive cash flow only, then that's one way to do it. There are risks with it, and we can talk about that personally one-on-one if you'd like. The second is what's called a systematic withdrawal. You take a little bit of money out of each account every year and live off of it. Often this is called the 4% rule, where you take a little bit out every year. The problem with that, and we're going to get to that in the next slide, is that does not really account for what we call sequence of return risk. And we'll talk about that here in a moment. And the third way is what I call the bucket approach, or a time and goals based approach. Money that you know you're going to spend in the next couple of years has a very specific intent and investment strategy versus the money you're going to need 10, 15, 20 years from now. And we can talk about that more in detail. But let's get to the sequence of return risk, because this is really what most clients don't understand. So when we talk about this, it's really somewhat counterintuitive, but it really can destroy a retirement plan. And it's something that we see a lot, especially when clients retire towards the top of a bull market like we are now. So what is sequence of return risk? When you're saving for retirement during the accumulation phase, the order of your returns doesn't really matter all that much. It helps to be front loaded, but realistically, because you are trying to get an average rate of return over a 30-year time horizon, the sequence is less important. But when you start the distribution phase, when you're living off the portfolio, now the ability to recover from the first year of a down market it becomes very, very difficult. And let's take this example. Both of these are two retirees with the same portfolio, same starting portfolio, same withdrawal rate, same risk tolerance, same everything. The only factor that we're going to change here is the rate of return that the portfolio earns in the first couple of years of retirement. The first retiree, the one on the left, if they retire in when the market is up 15% the first year and up 12% the second year, and then has a big decline, the portfolio loses 30%. That 30% loss is painful, but it's a 30% loss on a larger base. And the portfolio still has plenty of runway to recover. And after 20 years, retiree on the left has a $2.1 million portfolio remaining. Easy, right? No problem. That's a great outcome. But on the right, let's look at what happens if that 30% hits first. Again, same portfolio, same withdrawal rate, same risk. The only thing we're changing is the returns. The first year is a negative 30% right out of the gate. Now think about what happens. The portfolio drops from $3 million down to $2.1 million in the first year. In addition to that, you're now taking out $120,000 for living expenses. So now the portfolio is down to $1.98 million. You're down over a third of your portfolio and taking a withdrawal. And this is the first 12 months of this retirement. Now come the good years, right? Up 12, up 15%, but they're working on a much smaller base. The math never really catches up. The portfolio is permanently impaired. And over time, over that 20-year time horizon, the portfolio only has $310,000 left. That's not a retirement fund. That is scarcity, and that's a problem, right? They're looking at running out of money in their early 80s. Longevity risk kicks in. Survivorship kicks in if the higher Social Security beneficiary passes away and now there is less guaranteed income coming in. There's a lot of problems with that sequence of return risk. So what does this mean for you? It's really important for you to have a clear plan of where your income is going to come from. And your retirement plan needs to have a pre-built model of what happens if we have this sequence of return, where the first year is a big down year, right? For those clients who retired in 1998, 1999, going into the tech bubble, or retired in 2007, going into the housing bubble, right? Their retirements were permanently impacted if they hadn't done the work ahead of time to build in a strategy for those bear markets. I'm not saying we're in for a bear market. This is not a scare tactic. This is about being prepared and having a realistic understanding of the risk of when you retire and what could happen. It's really important to understand. The difference between the retiree on the left and the retiree on the right has nothing to do with luck. It has nothing to do with returns. It has nothing to do with risk. It has everything to do with preparation and planning. All right. We'll move on to decision 5. And again, I'll remind everyone, if you have any questions that you would like answered, please feel free to drop them into the Q&A. I absolutely will answer them live and go from there. All right. Decision number 5, choosing the wrong advisor model. I want to be transparent here. This is very self-serving for me. And I'm going to own that. But math is math. We just spent the first four sections of this talking about how to limit the lifetime amount of taxes you pay to the IRS. Well, you know what? Fees are another form of taxes. They're a silent compounding drag on your portfolio that most people don't really pay attention to. And I'm going to show you the cumulative effect on a $3 million portfolio. And unfortunately, that number may surprise you. The good news is this is something you can still change going forward. There we go. So as I said, this slide is very self-serving. I know that. I run a flat fee advisory service. I have a very strong point of view here, but I want to name that directly because it is important to acknowledge that bias. But here's the thing. Math doesn't really care about my business model or someone else's. The math is the math. And this, if you're looking at this slide, it should make everyone here a little bit uncomfortable if you're currently paying a percentage-based fee on a large portfolio. So let's look at the numbers. On a $3 million portfolio growing at a 7% rate of return, a percentage-based fee is going to charge you roughly about $30,000 in 1 year. It's not a surprise. You can look at your statements and see that that's been the case. But what most people don't think about is what happens over time. As the portfolio grows, that 1% fee is growing as well, and it's compounding on that bigger base. So over 5 years, that fee has grown to $172,000, not $150 that you would think on the $30,000 fee. It's grown because of the 7% growth. And over a 20-year time horizon, that's almost $1 million, $920,000. Now, some of this gets offset by withdrawals. The math has to be run for you. And we do have a calculator on our website, seveywealth.com/fees. If you'd like to go and calculate exactly what the fee difference is, feel free to jump over to that calculator. But when you look at the advisory fees that you're paying, you have to admit that there's a strong correlation to taxes. The more you have, the more they charge. And unfortunately, when you look at the work that we do from my side of the desk, the service level, the planning level, the way that we work with clients, it doesn't really matter if you have $3 million, $5 million, $10 million. The amount of the work doesn't really change. But under the old model, it's really important to understand that you are being penalized for success. Okay. Now, I want to be very clear about something. I'm not attacking any particular advisor. There are some really good advisors out there, really good, right? People who genuinely care about their clients and who do excellent work. If you have an advisor that you're working with that you trust, that's a valuable relationship. I'm not telling you to fire them. I'm not saying anything along that line. What I am attacking is the system, the model that these firms use. The 1% fee was built decades ago. It started with mutual funds, and then it was built when the industry was smaller, and it was a way to align incentives for the advisor. But if you're sitting on a $3, a $5, and $8 million portfolio, the model isn't working for you, right? Because the advisor is not doing any extra work, no matter how many zeros are in your number. It's something that it's really frustrating. I worked within that model for 20 plus years. I left to go and build this company and this platform because it was the only way I could really look my clients in the eye and say, this is why I charge what I charge. It wasn't really fair to clients to charge one client $20,000, $30,000, and another client $50,000 for the same level of work. Just didn't seem right to me. So the good news on this one is this is reversible. You can't go back and ask for a credit or a rebate on past fees, but it is something that you can fix and stop the bleeding going forward. Of all the irreversible decisions today that we've talked about, Social Security timing, beneficiary designations, Roth conversion windows. This is the one you can change. And so that's something, again, I know it's self-serving, but it is something that's very important to address. So, quick recap for you on all five, right? When we talk about each of these can have $100,000 plus dent on your retirement plan, sometimes up to $1 million, depending on the strategy. With Social Security, the generic break-even calculator to me is too simple for clients who have significant assets. It only looks at one variable, one single life, and when do you break even? When do you get the amount of money that you're entitled to? To me, it ignores so many things of tax optimization, survivorship optimization. Are you going to get thrown into a hidden tax with your Medicare surcharges because you decided to take it early, but then it kicked you into a couple $1,000 a year Medicare charge? It's just too simple of a calculator. The second one, the Roth conversion window. When we talk about when you retire and when you are forced to take distributions from your IRA, it's typically an amazing time to prepay some taxes at low tax rates before you are automatically bumped into higher tax rates. Again, limiting the lifetime amount of taxes that you have to pay. This also applies to your beneficiaries, your non-spousal beneficiaries. By prepaying taxes in an IRA via Roth conversion, your heirs, when they receive the money, they have 10 full years of tax-free growth. They can let that compound to take out. Whereas if it's in an IRA, they have 10 years to take that money out and pay ordinary income tax at their tax rate. And if you have successful children who are already doing really well and making a good income, all this is likely to do is bump them into a higher tax bracket, negating some of the benefit of the legacy that you're trying to leave behind. 3, beneficiary designations. The one thing I ask for you today, and it's really important, please take 15 minutes, not this month, this week. Please take 15 minutes and go through all of your accounts wherever they're held and make sure that A, you have beneficiaries listed, and B, they're the right beneficiaries. Okay. I've seen it too many times. Ex-spouses, missing beneficiaries, and now it goes to probate. Squabbling beneficiaries, people, dad said this was my account, but there's no documentation. Please, it's a 15-minute process. It's very easy to do, but this is critical to make sure that accounts are titled properly. If you have a trust, but your investment account's is not listed as the owner of the trust, that's an issue. If you don't have a beneficiary listed, that's an issue. Please, it's a 15-minute project I'm asking you to do this week, and it will save a massive amount of headache and time and likely money. Okay. Number 4, first year withdrawals. Understand what your plan for funding the first few years of your retirement is, and what happens if those first couple of years are negative years in the markets. There's a lot of strategies that go and planning that go into this. I have my preferred way, but when you think about that sequence of return risk, how can we make sure that you don't compound a down market by withdrawing on depressed assets if you don't have to? Okay. And then finally, 5, look at the fee structure that you're paying. If you are paying a percentage of fees, a percentage of assets under management, then it's something to really look at, understand what you're paying, what the lifetime amount of that fee is, and ask yourself if there's a better model out there. As you can imagine, I tend to think there is. Okay. All right, let's go ahead and open it up for any questions today. All right. One question I received, is your investment advice around specific stocks or only ETFs, mutual funds? My personal advice is I build custom portfolios for every client. If you want stocks, no problem. If you don't want stocks, no problem. It's really a custom-based approach. I don't use any models. I don't use any sort of pre-built portfolios. Everything is custom built directly around each client, their specific goals, their specific needs, and their specific risk tolerance. So that's the way I do it. I know most firms have allocation models. Most firms have very specific approaches. I tend to do it the way that I'd want my money invested in the when it comes to my own wealth and my own retirement. Next question. Let's see. No, that's it. It was we've already addressed it. So for the person who asked that question, I hope that answered it. I will. Any other questions that we want to answer here? All right. Before we move on, if you do have questions, but you don't want to ask it in an open forum like a webinar, I completely respect that. Scan the QR code. That does take you to our booking page. You can schedule a 30-minute conversation directly, or send me an email, send me a text, just reach out. Let me know how I can help and what questions you have and how this impacts your retirement. All right. As I mentioned, I do offer a 30-minute review. Any questions you have, please just reach out, let me know. More than happy to go through any of these 5 items in more detail, talk about how it impacts you directly, as well as offer any insights to your particular plan that you may be missing. Lastly, unfortunately, I do have to leave with a disclosure. The lawyers, unfortunately, ask us to leave the disclosure slide up. But if you have questions, please reach out to that QR code or send me an email, sean@cvwealth.com. There's plenty more information online, cvwealth.com. We also have a YouTube channel, YouTube@cvwealth. You can take a look at our content there as well. Thank you all for attending. I really appreciate everyone's attendance and their questions, and look forward to our next conversation. I hope everyone has a great rest of the day. Thanks so much. Bye-bye.